What's up guys, my name is Angelo. A lot of you have been asking me to show you how to get started with buying ETFs in Europe, so it was about time for my first video specifically on this topic. So here's what we're going to be talking about today. We'll start by looking at what the hell ETFs are in the first place, in case you have no idea, and why I consider exchange-traded funds to be an important part of my personal asset allocation. Then you'll get a detailed look into my brokerage accounts where I hold my ETFs, something that I haven't shared publicly before. I'll also show you how to buy them on Degiro, the most cost-effective way to buy ETFs in Europe right now in my opinion. Then I'll quickly go over the differences between accumulating and distributing ETFs, something that might be relevant to you depending on the tax laws in your country and your personal preference. And lastly, I'll try to explain the two different account types that Degiro offers when you sign up to better help you decide. But before we get started, if you'd like to see more videos like this, then don't forget to hit the like button for the YouTube algorithm. And if you'd like to support me, you can find all the links that I mentioned in this video in the description below. Alright, as I showed you in my video about my entire asset allocation back in the end of November 2019, my wife and I currently have close to 30% of our net worth invested in broad, low-cost ETFs compared to quote-unquote only 25% in peer-to-peer lending. Just as a reminder, in case you assume that I was all in on peer-to-peer lending simply because it's the main focus of this channel so far. Alright, let's talk about what an ETF is and why it's an important part of my asset allocation. ETF stands for Exchange Traded Fund. In this video, we'll be exclusively talking about stock ETFs, tracking large stock market indexes like the FTSE All-World or the MSCI World. These ETFs allow us to passively own a large number of single stocks, covering most of the world economy, and to participate in the long-term growth of the global market. All with minimal costs and while being able to sell our ETF shares quickly and easily via exchanges. Here is our favorite one and the only one that we buy on a regular basis, the Vanguard FTSE All-World. Via a single ETF, we're able to invest into over 3,300 companies from all over the world. We're not placing bets by buying single companies which could always go bankrupt, costing us our entire investment. Instead, we're counting on the global economy as a whole to continue growing over time, as it has over the past hundreds of years. Who knows if Apple or Microsoft will still be as profitable or as relevant as they are today in a decade or more, or if they will be replaced by other more successful companies. We also don't know if the US will still be as relevant as it is today, or if we'll be interacting more and more on a daily basis with companies that are maybe based in China or India. And if more and more work can be automated by AI or done by machines instead of humans in the future, we want to earn a chunk of that increased profitability as well. Our goal is to get our share of the profits and growth from companies from all over the world. And the easiest, most cost-effective way to do that is by buying ETFs. After all, trying to get better returns than the market is extremely difficult over a longer time horizon. A lot of much smarter people than you and I have failed before trying to do that. There's one thing you should know, however, before we continue. If you've never invested into stocks or ETFs before, you need to understand that prices don't only go up, they also go down on a regular basis as the market is volatile. What I'm trying to say, if you decide to invest into ETFs, this needs to be a long-term decision. You should be aiming to invest for 10 years or more. Based on over 100 years of stock market history, we're expecting long-term returns of around 7% per year on average. But this doesn't mean that our account value is simply gonna increase by 7% per year on a regular basis. To give you a better idea, this is what this actually looked like over the past 14 years. Here's the data from the All Country World Index, which is very similar to the Vanguard FTSE All-World that I mentioned before. Since December 31st, 1987, this index averaged 7.96% per year. But this average came with a lot of volatility, as you can see here. For example, in 2008, during the last financial crisis, the index was down 41.85%. That's why I'm telling you, you need to treat this as a long-term investment to get the average returns of the market. Don't buy ETFs if you know that you would freak out and sell if the market drops by 20 or 40%. That's part of the game and will likely happen again. Now you might be thinking, well, if that's the case, then I'll just wait for the next stock market crash and buy in at a lower price. That's called market timing. A lot of people before you have tried to do exactly that and have failed miserably. As a general rule of thumb, there's a saying, time in the market beats timing the market. Nobody can successfully predict a market decline, so I don't try to either. I simply invest, and if there's a correction, I treat it as a discount to get more shares at a cheaper price. For my wife and I, ETFs are an important part of our asset allocation and our long-term investments. We're not planning to touch this part of our portfolio over the next 10 to 15 years or more. They're also part of our retirement fund for when we get older, as the current pension system in most countries in Europe is clearly unsustainable. Not only that, but we also consider ETFs to be a good protection against higher inflation in case the euro or another currency loses value for whatever reason. In the past, the stock market has been a good hedge against hyperinflation, as was the case in Germany between 1920 and 1924. And if you want to learn more about ETFs in general, I highly recommend checking out Ben Felix's channel on YouTube. He makes excellent science-based videos all about index investing via ETFs. Alright, it's about time I show you how to buy your first ETF on Degiro as well as my other brokerage account. Since the taxation in Austria is a bit more complicated than in most other European countries, I started out with this Austrian broker Flatex, which takes care of the taxation for me. And my wife also has another brokerage account at Flatex. So here you can see my total account value at the moment as of February 13th. 2020, how much my positions are up at the moment, so 15.87%. By the way, you can ignore this part here of the MSCI Pacific. That was still part of a way more complicated strategy which I used in the beginning, but which I removed later and which I moved to a much simpler one ETF strategy of just buying the Vanguard FTSE All-World ETF. I'm still keeping my positions in the MSCI World though, since pretty much 90% of the All-World is made up of the MSCI World anyway, and this one just adds 10 to 11% of emerging markets. Alright, so first of all, here is my Degiro account. By the way, I'm sorry that it's in German, sadly I can't change the language to English. And for some reason the graphs weren't showing up on my desktop, so I switched to the mobile app here on my phone. So here's my account right now. At the moment I have 11 shares of the Vanguard FTSE All-World ETF for a total of 963 euro here. I have 1,108 euro and 49 cents as cash up there, which I want to invest into more ETF shares now. So what I can do is either I just click this and then I buy more shares here. Or, if you're new, I'm gonna copy the ISIN number here. I'm also gonna put it in the description and I'm gonna search for it here. I'm gonna paste that, and here, up here we have the ETF that we want in euro. Okay, the current price is 87.5 euro per share. And since I wanna buy it right away, I'm gonna put that as my limit. So the limit buy, 87.5. All right. And I'm gonna put 1,108 euro, which is exactly the amount I have as cash, and then it's gonna automatically calculate how many shares I can buy with that, with the remaining amount staying on the account as cash. Here I'm gonna say without time limit, otherwise the first one is like until the end of day. Here's without time limit, so whenever it hits that price. Okay, and I'm gonna place the order. Here we can see it's gonna be 12 shares of the Vanguard FTSE All-World ETF. It's gonna be a total of 1,050 euro. And I'm gonna hit confirm. Alright, so I just got an email that the order was executed successfully at 87.5 euro per share for a total of 1,050 euro. And as you can see, it's also showing up in my Degiro account. So I now have 23 shares instead of 11 of the Vanguard FTSE All-World ETF. So it seemed like there were some issues with the Brave browser. So in the Chrome browser, the charts are being displayed correctly. As we can see, today is a down day because of some coronavirus fears, which is great since we're able to buy at a small discount. I'm just gonna quickly show you here the portfolio looks like, and here you can see the 23 shares now. And so far on this small portfolio, which I just started recently, we have unrealized profits of 1.26%. Up here you can see the portfolio change today, since today is a bit of a down day, and here's the remaining cash, as well as the total portfolio value, the invested money, and the invested money including the cash is up here. And by the way, you can also save this ETF in case you want to buy this one again in the future. You can also save it under favorites to access it more easily. Now that you know how easy it is to open a brokerage account and to buy an ETF, we need to talk about another less sexy topic, taxes. So here's the deal. I'm a tax resident in Austria. We have a very complicated way to tax ETFs compared to most other countries in Europe. That's why we currently have most of our ETFs with an Austrian broker, which automatically takes care of the taxation for us. But I'm slowly adding more and more to Degiro, as it saves me a lot in fees and I have to do my tax returns anyway. In most other countries in Europe, the taxation is much more straightforward. You simply pay taxes on the capital gains when you sell an ETF, as well as on the dividends you receive. Just please make sure you do your own research so that you know exactly what applies to you and your specific country. In that case, it could be advantageous to buy an accumulating ETF, meaning an ETF that automatically reinvests the dividends into the fund and doesn't pay them out. I personally don't do that, even though it's less tax efficient, and here is why. It's quite simple. I like receiving some dividends on a quarterly basis. Seeing that cash flow increase over time motivates me to keep investing and to stay invested, no matter whether the market is up or down at the moment. And I do think that this could be a psychological factor for many that you shouldn't forget. I still reinvest the dividends that I receive from my ETF on my own, but I might also use the cash flow to fund my lifestyle one day in the future without needing to sell any part of my investment. If you decided you want an accumulating ETF, so an automatically reinvesting ETF that doesn't pay dividends, one of the best ones that I found on Degiro's free ETF list is the iShares MSCI World. The companies in this index are very close to the Vanguard FTSE All-World, which we buy. The most notable difference is that it's missing an exposure of around 11% currently to emerging markets, meaning countries like South Korea, India and China. Nonetheless, in my opinion, it's a great ETF to start out with and to invest into stocks long term. And it's completely up to you if you want to add an additional ETF covering emerging markets, for example, later on. Let's talk a bit more about Degiro specifically for a moment. Degiro is a licensed, regulated investment firm based in the Netherlands. As such, they're supervised by the Dutch Authority for Financial Markets and the Dutch Central Bank. Your assets are always held in a separate entity, which is standard practice across investment brokers. That means that your ETFs are held separately from Degiro and can't be touched in case they would ever go bankrupt, for example. When you open an account, Degiro asks you to choose between two account types, Basic and Custody. I will only look at the main differences between these two account types, at least from our perspective as ETF investors. Cost-wise, the two accounts are pretty much the same if you're buying ETFs. Both accounts are completely free to open and there are no maintenance fees. Only after you started investing on Degiro and you have your first ETF in your account, Degiro charges €2.5 per year as an exchange connectivity fee. If, for example, like me, you're only buying free ETFs from the Euronext Amsterdam exchange, you'll only pay this €2.50 fee once per year. Okay, but now let's look at the most notable differences between the basic and the custody account. That way you can decide for yourself which one to choose when you sign up. The basic account charges no fees on dividends. The custody account, on the other hand, charges a dividend fee of €1 plus 3% of the dividend, but never more than 10% in total of the dividend, which matters in case the dividend is small in the beginning. What this means, for example, if you receive €50 worth of dividends on a basic account, you pay 0 fees. And if you receive €50 as a dividend on a custody account, you pay €1 plus 3%, meaning €1.5. So €2.50 total as a fee on these dividends. Apart from the dividend fee, here's the most notable way in how these two accounts differ. With the basic account, the shares you own can be lent to third parties, while there is no lending whatsoever with a custody account. However, here are Degiro's measures to minimize any potential risks related to lending shares with a basic account. First, as I mentioned, the assets are always held in a separate entity, so they can't be touched in case of Degiro going bankrupt. Second, Degiro always requires a collateral of at least 104% of the share value to minimize any risks before lending can take place. And third, Degiro itself always acts as the counterparty in the lending process. That means that if, for whatever reason, the borrower's securities are unable to cover the value of the borrowed shares, then Degiro makes up for the difference with its own funds. Nonetheless, here's the very unlikely worst-case scenario with a basic account as explained by Degiro. Damage for a client whose securities are lent therefore arises only at the moment when both the borrowing party and Degiro are no longer able to meet their obligations, i.e. are bankrupt, and the value of the security has fallen or the value of the lent securities has risen. The amount of the damage is limited to the difference in value between the lent securities and the security provided by the borrower. Now, the other question is how likely our specific ETF shares are to be lent out, as I don't think there's a lot of demand for borrowing the shares of our broad worldwide index fund compared to single stocks. Nonetheless, this still means that a basic account carries a bit of counterparty risk, limited to the amount of the difference between the collateral and the current share value, if both the borrower and Degiro were to go bankrupt at the same time. That means that if you want to completely avoid the possibility of any of your shares being lent out at any time, as you don't like the idea and you want to eliminate counterparty risk completely, then choose the custody account when signing up. In the end, in my opinion, the extremely low transaction fees or even the free ETFs more than make up for the small dividend fees you would have to pay with a custody account. And if you're only buying accumulating ETFs, meaning ETFs that don't pay out dividends and instead reinvest them into the fund right away, then you're not paying any dividend fees in the first place, and a custody account is pretty much a no-brainer in my opinion. By the way, if you have a basic account and you want to switch to custody, you can simply register a new account and then ask them to move over the shares to the new one. I currently have a basic account myself, but as my account value grows, I'm gonna consider whether or not to open a custody account and move my ETF shares there. I hope that you now have a bit more information on the differences between the two account types so that you have an easier way deciding. I thought it was worth mentioning. Either way, I'm really loving the ability to buy my favorite ETF, the Vanguard FTSE All-World, for free once a month on Degiro, as well as whenever I want to invest 1,000 euro or more. I'm definitely planning on buying more of my ETF on Degiro in the future, as paying no fees compared to 7 or 8 euro every time I buy the ETF on my Austrian broker definitely adds up over time. By the way, for more infos on that, make sure you check out Degiro's free ETF list, which currently includes around 200 ETFs which can be bought commission free. So hopefully I was able to provide you with a bit more insights on why ETFs are an important part of our asset allocation and give you an idea with how you can get started with buying ETFs as well. That's it. I hope you enjoyed the video. As usual, if you'd like to support me and check out Degiro for yourself, as well as anything else that I mentioned, you can find all the links in the description below. And don't forget to like the video and to subscribe if you'd like to see more videos like this in the future. Last but not least, before you take off, I would love to know in the comments if you're completely new to ETF investing or if you already own some ETFs yourself. Thanks for watching, and until next time.